Hi, this is Jim Cunningham, and we're going to talk about housekeeping items for your financial health 2024. This is the basic financial hygiene that really, if you have any kind of wealth at all, these are things that are just best practices. I have my good friends, Christina and Alyssa, with me here today, both certified financial planners, and they do a great job for our clients and our friends. So
we do offer securities. Alyssa and I and all of our advisors here are certified financial planners. We do offer securities. We do have a registered investment advisory firm. So some things we do on a fee basis, some things we do on a commission basis, so we can do what's in the best interest of our clients. We are fiduciaries. We are obligated to be acting in the best interest of our clients at all times. And this is certainly not an offer to buy or sell securities, and everything we do is individualized.
And I'm a lawyer. And just because I'm talking and words are coming out of my mouth, this is not legal advice. There's no attorney-client relationship by you watching this, much like Shark Tank. If you're watching Shark Tank, no one's making you an offer. It's a TV show. This is a video, okay? I'll let you take it away, Christina and Alyssa.
Awesome. Thanks, Jim. So we really just kind of want to get ahead of what are some things they need to be aware of? What are some changes in 2024? What things are coming into effect from the Secure Act 2.0 that were kind of the can kicked down the road that weren't implemented yet. So just some basic hygiene. And so we're going to kind of get into it as far as what you need to update.
Yeah, great. So I think a lot of people, you turn over the new year, you're starting a new year, you go, wow, it's 2024. I'm going to do this. I'm going to, get the gym membership. I'm going to drop those 10 pounds. I'm going to get my financial house in order. Like, I'm going to do it this year. It's going to happen, right? So we're going to talk about the steps that you can take to get there. So I will be speaking. I will be listening a lot on this one, but I'm speaker Jim Cunningham, and I'm a partner at Cunningham Legal. 30 years experience this year. I think I might cap it at that. We have offices throughout California, and I'm a certified specialist in estate planning, trust, and probate law, real estate broker, securities, and insurance license, and a pilot. These are the lawyers in our firm. We have our team is dedicated to effectively the mass affluent and helping people with means keep more of your money, right? Pay less tax and get the money to the people that you care about after you pass away. We've got Christina, Alyssa. Shannon's not with us today. She's got a super important meeting, I guess, meeting with some smart people about the world of finance. So you guys gals are always staying on top of things and making sure that you have all the current information, because this is a dynamic, right? It's a dynamic situation, investment advisory space. So with that, I'm going to start it off with review beneficiaries, because this is something that's near and dear to my heart. And I promise I will let you talk. So this is really important. A lot of people think that their will or their trust dictates how all of the assets are going to get distributed when somebody passes away. It simply is not true, because things that have a beneficiary designation, what we're talking about is if you have an IRA, an individual retirement account. So if you have an IRA with Alyssa or with Christina and you pass away, it doesn't matter what your living trust says. What matters is what's on file at the institution. And that what's on file at the institution says, when this person or these people show up with your death certificate, they get the money. That's what that means. So it doesn't matter what your living trust says. So it's really important to review those and make sure that the beneficiary designations are aligned with your estate plan. So with that, I will let you take it.
And you typically don't want your trust to be the beneficiary. So, and I say typically, there's exceptions to the rule. There are special needs trusts. There are people that have no children that want to leave things to charity, that have a different legacy desired plan. But if husband and wife, married couple, or any married couple, you don't want trust as primary beneficiary. You want your spouse as your primary beneficiary.
Yeah, and one thing, I'm not sure we had our disclaimer in here about this is not legal advice, but did we have our disclaimers in here?
We should.
Should have them. Well, here's the disclaimer. We're talking. This is not legal advice. So as a general rule, Christina, you are correct. Yes. Generally speaking, it is you want to pump the brakes. It's a bad idea. You want to look twice before you name a trust. Why is that? Because if you name your living trust the beneficiary of your IRA, many times what happens is all that money has to come out of the IRA either in a year or 5 years, but it's a really bad outcome because a lot of times a lot of taxes come with that, right? So
Yeah.
you take a dollar out of your IRA, you're going to have to pay tax.
So typically we don't want that to be the trust, but facilitating a beneficiary review is basic financial hygiene. It's one of the things that we do often, and we do every single time that we meet with our clients, and every single review meeting that we have with our clients, we go over those beneficiaries. Has anything changed? Has there been any deaths in the family? Has there been any, divorces or those kinds of things? So we want to make sure that that is a regularly facilitated update. Tax loss harvesting, also making sure that we're looking at each year. This is something that we did heavily in December because it was year end. Are there any stocks that have gains that we could offset those taxable gains in a taxable account with losses in other accounts? And if for certain clients that do have, most clients do not. I think studies show that most clients have one financial advisor, especially as clients enter retirement. They consolidate to one financial planner because it's like having two general physicians and not knowing what one hand is doing. But the same is true with wash sales. You don't want one advisor selling Microsoft shares at a gain and then selling and waiting 30 days is the rule to, if you're selling something else at a loss or you're selling it at a loss over here, you need to wait 30 days before purchasing it. But if one advisor doesn't know what the other advisor is doing, it's going to cancel each other out. So wash sales, when you're doing tax loss harvesting, becomes more complicated when you're dealing with multiple advisors. But that is something that is just basic hygiene, looking at your taxable gains from your portfolio and what can be trimmed to reposition things.
Yeah. And, we had that drawdown in the market. We started the market last year in 2023, we started low and there was a big run up in a lot of the indices and a lot of stocks. Not all of them, some go down, might have some that go way up and you got this one that comes down. It's really important to pay attention to those on the individual level. Maybe also talk a little bit, what if I have Apple stock in my own name and Apple stock in my IRA? Does the wash sale apply to the stock in my IRA and the stock that's in my name if I'm buying from one account and selling from the other?
No, this is only for non-qualified accounts. However, if you have an individual account, Jim, and then you also have a trust with your spouse and your social is the, same tax return, it does matter in that circumstance. If you have an individual account and a joint filing tax return with the same socials, it is going to also cancel each other out. So we want to make sure that there's proper aggregation done. So tax loss harvesting is a bit more complicated than I think most people think of, which is, again, one of the reasons why having a proper fiduciary financial planner that does have the proper training to do the tax loss harvesting is important. The other thing that we have on here is Inforce illustrations.
No, wait, Christina, Inforce illustration. Is this Star Wars or what is this? Is this like Inforce illustration? What is it?
This is something that with life insurance, it's something that we do recommend doing about 5 years into a life insurance policy. You want to do it probably annually thereafter. The first 5 years, if you've kind of stuck to the plan and design of the life insurance policy, and we're talking about permanent life insurance policies, not term, not group insurance, not insurance with your work. We're talking about permanent life insurance policies, whether it be an index universal life policy, a whole life policy, a second to die policy, an ILIT policy, any of these types of permanent policies, we want to make sure that they're performing as intended. Interest rates change. Interest rates have a lot of sensitivity on how the actuarial design and life expectancy of the actuarial tables are done on an existing policy. So people are living longer than they were 20 years ago. And so something that you put into place 20 years ago might be differently performing today than was intended. It's a different interest rate environment. It's a different actuarial table environment. So we want to make sure each and every year, if you have a permanent life insurance policy, we are ordering Inforce illustrations. And we want to start with just how it was designed. Is it performing? And then what we do as advisors is we sit down with our clients and we go, okay, it looks like it's overperforming, or it looks like it's underperforming. We now want to ask the insurance provider to run us XYZ scenarios. What if we were to stop paying premiums? What if we were to pay extra? What if we were to decrease premiums and not pay quite as much as we were used to paying? Can we save our clients a little money and still keep the policy intact as it was designed? So Inforce illustrations are incredibly important. And if your advisor is not doing that on an existing life insurance policy that you have, it's critically important.
Yeah, and I know I was speaking with the trust company. You know, a lot of people will have a life insurance policy inside of a trust, and we've covered this in other videos, so that it stays out of your estate. I mean, that's really the big reason. So it stays out of your estate. So, you know, I could get a policy for $10 million, and that 10 million passes tax-free to my loved ones after I pass away. So it's not included in my estate and not paying $4.5 million in death tax. Those trustees, I was talking to one trustee, they do this every year for the policy because they're typically handling larger policies. So this is one of the things that you need to pay attention to. Now, what do you mean? Because when you say underperform, that sounds like a negative thing. Like that's a
And
real
it very well could be. It could be that you had, if you paid $1,000 a year in premiums for a $1 million death benefit, and that is supposed to be a guaranteed death benefit to age 100. It could be that $1,000 a year premium, because interest rates have changed or the insurance carrier underestimated the cost, could be that that's now only guaranteed to age 90, that you have to increase your premiums in order to keep it the same death benefit. So underperforming could mean, hey, we just want to get ahead of this. We want to start figuring out what we need to do to get the policy to perform as intended, or can we take it out of this exchange, you know, this suitcase carrier and put it into a new carrier and do an exchange to improve the terms. And that's something that Alyssa and I analyze on a regular basis with our clients.
So what happens if you're 90 and the policy kind of falls apart? What is it, a taxable event? What happens?
Well, that's why it could be, it could not be. So those are things that's why you do Inforce illustrations, is to get ahead of this. And we have a question real quick before we move on that I think is relevant, just real quick while we're on this. It was anonymous, has a beneficiary question. If the IRA has children as beneficiaries, does Schedule A list the IRA, or is the IRA for non-beneficiary assets? So again, IRAs are only beneficiary designated.
Let me answer this. Sometimes lawyers will put assets on a Schedule A for one of two reasons. Either the lawyer doesn't know, I'm assuming a lawyer did this, either a lawyer doesn't know that you're not supposed to put an IRA, which is actually kind of common. So lawyers don't know enough about IRAs. It could also be that it is a schedule. That schedule could be a schedule of non-trust assets. So it's there so people, that's flagged and people know it. And sometimes people just list it knowing that it's actually not in the trust. They do list it on the Schedule A. But typically, you know, in our firm, we're not listing those IRAs on the Schedule A. We have it in a different location in the estate planning portfolio. So a living trust is part of an estate plan. So a living trust typically has a will and durable powers of attorney for property and healthcare. These are other documents, much like a car has an engine, but it also has a transmission and a steering wheel and a seat. It's, you know, if the living trust is the engine, it's just that one thing. So it's very important to understand that, you know, lawyers and non-lawyers put a lot of stuff on a Schedule A. And just because it's on the Schedule A does not mean it's in the trust. So if you list a property, let's say you never put your house in the trust and you list it on Schedule A, well, that's not a trust asset. The way you transfer real estate is by deed. And we cover this in other webinars, but you transfer that real property by deed.
In most states that are community property states, California being one of them, if you are legally married, you have to have a spousal waiver to have a child listed as a beneficiary and not your spouse.
Yeah.
And so those are some other considerations, because I know that was mentioning, can you leave your children? That depends on what the rules are of that state and if there's waivers required.
Yeah. So this is interesting. You raise this, and this I think goes to basic financial hygiene. Did you know, if you're watching this, did you know that yes, you need spousal consent if it's an ERISA plan, which is a 401k or the 403b or all these other ones. But if you do an IRA rollover, you don't have to get spousal consent to name your kids. So people can be really sneaky when it comes to estate planning. That's why you want to check. The other thing too is institutions lose paperwork. Now it doesn't happen that often, but it does happen, or like they can't find it, or it's really outdated, right? And I think that's probably more common. You might have people who are deceased on there that really shouldn't be on there as beneficiaries. It just kind of makes it a little more difficult. All right. Business owner considerations.
Yeah. This one's
Yeah,
new. I might let you talk about this. This is very new, but there's some
yeah.
things that are different this year for business owners.
Yeah, so this is a slow rolling. I don't want to say train wreck, but it's a slow rolling locomotive, and it comes with imprisonment and a $500 a day fine for a violation. So we covered this in our last week's webinar. This is this new era of reporting beneficial ownership in entities under the Corporate Transparency Act. You're going to see a lot of this in the news in the next year or two. But right now, if you create a business entity, if you do something with the Secretary of State, so this is creating an LLC, it's creating a corporation or creating a partnership where there's a filing at the Secretary of State. Now, not all partnerships need a filing, but when there is a filing at the Secretary of State, if it's a small business and a small business is defined as less than 5 million in revenue, fewer than 20 employees, or no physical presence in the United States, no office. So these are going to be, if you own a piece of real property in an LLC, which a lot of our clients, they put rental property in an LLC for a variety of reasons, you're going to have to start that reporting. If it was created before 2024, that reporting starts in 2025. You have 30 days from January 1 to report it. And you go to the Treasury's Financial Crimes Enforcement Network. That acronym, Financial Crimes Enforcement Network, these are not your friends, okay? They're gathering information to prosecute crimes. The two things they're going after are money laundering, and the other one is people not paying their taxes. So believe it or not, people, if everyone paid their taxes, guess what? The rates actually might be lower. But I think a lot of people aren't paying their taxes, and there's a lot of criminal activity going on. So that's the design. That's what it's designed for. And just stay tuned on that. If you have an LLC or you have an entity, this is something you're probably going to need some help on to register the company. And then whenever beneficial ownership changes, if anybody gets 25% or that 25% changes hands, you have 30 days to report that. If you don't report it, it's a $500 per day penalty, up to $10 million, and up to 2 years in prison. So very, very important. The Corporate Transparency Act, you need to pay attention to it, but it's something, again, it's like basic hygiene. By the way, Christina and Alyssa, I was meeting with a partner at a national accounting firm, and the partner told me, our firm is not going to get involved in that. We're not going to be doing the compliance work, and none of the big CPA firms are going to be doing it. So I'm not sure.
Really?
Yeah, I'm not sure I would rely on your CPA to do this, because if the big firms aren't doing it, I suspect the small firms might get really nervous and not want to do it either. So it's just yet
Interesting.
another thing you have to do if you're a small business owner now, right? Just yet
Yeah.
another reporting requirement. So
Yeah.
but
But
I'll let
along
you
those lines would be corporate structure. Some people, especially with the pass-through entity tax, which we've covered on past webinars, with S corps and certain states that they can't deduct the state income tax on their 1040 or their Schedule C or their sole proprietorship. They can't carry through the state income tax deduction. They'll do it through the entity. So some people created S corps, and it's still probably the proper structure, but along that, if it was a new S corp created in 2023 or later, it's going to require FinCEN reporting this year as opposed to next year, starting this month. So S corps, a lot of people did create new S corps, but reviewing your corporate structure, does it make sense to have an S corp? Can we save you income taxes by doing it that way? Family payroll, should we put a family member on the payroll to do additional 401k deferrals or profit sharing? So these are business considerations, especially with, income levels of your business. Has your business been on a high trajectory growth? Should we change the corporate structure? Those are things that are basic hygiene that ideally you want to kind of get a feel for earlier in the year, so you're not having to do things retroactively. And also, should we diversify your investment strategy beyond just your business interest? A lot of business owners, their wealth is tied up in their business, and that may or may not be preparing them for retirement. So we want to make sure that we look at that when it comes to your long-term plan.
Yeah, just to point of clarification, if you created an entity before January 1 of 2024, you're not required to report until 2025. If you create an entity in 2024, you have to report it this year. The other thing to take a look at is if you have business partners, look at your buy-sell arrangement, or what happens if a partner separates from the company, which means quits, becomes incapacitated, can't handle things. If you're a dentist, by the way, dentists, their dental practice must change hands or be shut down within 30 days of death, because they've got scheduled drugs. We learned that when one of our clients who was an oral surgeon passed away. So these are really, really sort of basic things. How often, Christina, I think if you have a buy sell and you're a business owner, I would recommend looking at that every year, because a lot of these have a predefined value on there. They say, if
Mhm.
I die, then this, then this is the value that we're going to put on the total corporation. It's very
Yep,
important to refresh that, because that can be a bone of contention among
sure.
business
Yep,
owners.
looking that and pre-planning for your exit strategy. That's important. What's the value? What's the tax implications? If you're looking at a potential sale, making sure that you're planning prior to any letters of intent, because once the letter of intent is signed,
Yeah.
Jim and I
Yeah.
Jim and I can't do a whole heck of a lot once the letter of intent signed.
Yeah,
Uh,
it shrinks the available planning
right.
strategies. And I would say I love S corps. It's like I feel like I need a stuffed S corp animal in my office, because S corps are great for operating businesses. It's probably the worst entity to have when you go to sell your business. So that's a lot of people don't talk about when you sell it, because your tax mitigation, tax planning strategies are significantly fewer. They're less than if you had a partnership or a C corp structure. And I'm not saying change your S corp to a C corp or a partnership. What I'm suggesting is that there are fewer planning strategies available, and with the S corp, the advice oftentimes is, oh, suck it up and pay that tax or whatever it is, or you have less options. But there are some planning strategies for S corps. Well, let's talk about retirement contribution limits. So why do these go up every year? They're tied to inflation, aren't they?
Yep. Alyssa, I'll let you kind of cover the new adjusted limits.
Yeah, so typically the IRS adjusts the limits about $500 every year. So last year it was $22,500 for 401k contributions. So you'll see that $500 adjustment for 2024 for 401k contributions. And that applies to Roth or traditional 401k. So if you're lucky enough to have an employer that allows you the option to contribute to a Roth 401k, not just a traditional 401k, and we'll talk a little more about the advantages of both here in further slides, but if you are lucky enough to have that option, that still is the same $23,000 contribution limit where you're able to contribute up to that amount. Just know that with Roth 401k contributions, you are paying the taxes first before you're contributing. And so you can contribute up to that amount. With a 401k, if you're over 50, you have a $7,500 additional catch-up contribution that you can make. So your limits are actually higher because the IRS is allowing you to catch up your retirement. That's what that's there for. For IRAs, if you don't have the luxury of contributing to a 401k or an employer that provides a 401k option, you can still contribute to your IRA in a tax deferred basis up to $7,000 if you're under the age of 50 and $8,000 if you're over. With STEP contributions, those did increase this year up to 69,000. So it's the lesser of, it's not 69,000 for everyone. It's the lesser of 25% of your overall income or $69,000, whichever is less.
And
then
that's an important point, because a lot of times, I will say overwhelmingly, many CPA, especially solo practitioners, not that they're doing anything wrong, but the default is to tell a self-employed individual or a sole proprietor to do a SEP, do a SEP, do a SEP.
Yeah.
And oftentimes it's not the best strategy for the client. It might make more sense to do a solo or individual 401k, because you could have $36,000 and actually still contribute $30,000 if you're over 50 to a 401k, where you're limited on the SEP. So depending on earnings, it may or may not make sense to have a SEP. It might make sense to really transition to a 401. So that's really where a proper analysis of corporate structure, as well as what type of plan you have to go with it.
Christina, you're highlighting something. I was at a conference, a national conference last fall, and a very well-known CPA speaker, super well-known, made a comment that I thought was very insightful. And I think I mentioned this in a prior webinar, but it used to be that CPAs helped people with their 1040s, and CPAs did a lot of financial planning. They just did, because, they're meeting with you every year. The financial advisory, I'm talking like 30 years ago, the financial advisory space did not exist like it does today. And what he shared was that advisory component is really shifting from the CPA to the Christinas and Alyssas of the world, to you ladies, because that, because the CPAs don't want to do the 1040s for the regular mom and pops, those people, those are really drying up. CPAs want to do work for business people, but what they're finding is that financial advisory is moving from the CPAs to the certified financial planners and the other professionals. So just if you're
Well,
watching this,
yeah,
if you're
and we
watching this,
certainly,
that's why. Yeah.
yeah, and we certainly don't do tax returns, and it is harder. I mean, you bring up a good point there. The single filing, the simple tax return, the simple 1040 that doesn't have business ownership interests. It's just it's W-2 income or retirement income, dividends. And the average client doesn't want to do TurboTax. They're used to going to see a CPA or a professional for that, but the CPAs, it's becoming more EAs or having to refer them to a tax preparer, because we do the planning, but we don't file the tax return. But you're right. A lot of the planning aspects of it is switching to the financial advisors.
Right. And we'll work directly with your CPA in coordination to make sure that any tax mitigation strategies that we are doing or implementing for a client, that it is in compliance with whatever the CPA's suggestions are, and that we're collaborating on your behalf. And with this chart here just shows Roth versus traditional. What's the difference? Non-taxable, the red is it's taxed up front before you eventually take it out. So essentially the red is your principal's originally taxed. So it's net of taxes, your gains are taxed, and then it comes out to you. Original principal comes back out to you net of tax or tax-free, because that's your original cost basis. Traditional pre-tax retirement. So this is like traditional 401k monies, IRAs, not Roth IRAs, things like that. It's going in without taxes. So it's pre-tax. The gains are still deferred pre-tax. And then when it comes out to you, that's when you have that nasty tax bill as ordinary income when it comes back out to you. And then Roth retirement, you're paying that tax up front. The gains grow tax-free and it comes back out to you tax-free because you've paid the IRS their fair share originally. So really, that's something that we're doing a lot with clients at this juncture right now, is making sure that does it make sense to continue to defer that tax and contribute all to the traditional bucket? Does it make sense to do a little bit of both, or does it make sense to switch to doing all Roth contributions at this stage of your life? And that's an analysis that takes a lot of thorough diving into and really looking at your income brackets, what's going to push you over. Is there room in there to do a portion of it Roth? If we don't do Roth and we continue to do traditional, are you now exacerbating your RMD issue later down the road? That's a massive problem that we are seeing right now, is people have deferred. Now they're getting into retirement and they're wondering what their required minimum distributions are going to be. And potentially they're higher than what their actual income when they were earning an income is. And so they're going to be in a much higher tax bracket. And so can we get ahead of that? Can we do some Roth conversions? Does it make sense to stop kicking that tax can down the road and take advantage of doing a Roth contribution at that point?
Yeah, Alyssa, this is so important because we have a lot of clients that have worked at UC. We've got offices in the Bay Area, so you've got people that are either kind of in that Stanford orbit or the UC orbit or Lawrence Livermore Labs, and they come out with these huge retirement accounts. I mean, or Chevron, right? You might come out with a $2, $3, $4, $5, $6 million retirement account, and when you hit your RMDs, if you have real estate, it's probably all depreciated, right? You don't have a lot of deductions, and now you have to take money out of the left pocket and put in the right pocket. We see clients with RMDs in the several $100,000 a year amount, and then that makes your Medicare Part B kind of get all messed up, and it has all these outsized effects. And also, if all your money is in qualified and you want to do a Roth conversion and you have no assets outside of your retirement account,
Pay the tax.
You really can't do that. So we do have a Roth conversion question here. Anita, whether a business has to report or not, I covered that because there was a question here about the Corporate Transparency Act. Look at that video from last week, but we did cover that. And that's something that if you do have an LLC and Anita as a client, just reach out to us and we can walk you through that. Anonymous asks, if you convert to a Roth, should you do it at the end of the year so you have all that money invested for the year, or convert it at any time of the year if you have a good idea of what your tax brackets are?
Depends.
Good question.
Depends. It really depends on the individual client. That's really why it does take some analysis, because you want to know, are there other circumstances that could allow for different tax treatment, if you were to do a Roth conversion. So, we have another client that we're going to probably do a very, very large conversion for later this year. That's because they're going to have a loss coming from the estate of his mother that he can take as a loss on his own return. And very few times can you do, like, there's just different circumstances that you want to, every circumstance is so unique. So I will say that.
And that's why we do mention this a lot. It takes a team of advisors. This is why it takes the CPA, the financial advisor, the lawyer, everyone working together. And, if the numbers are big enough, it can be meaningful. I mean, even if they're small, it can be meaningful. Anita asks, can regular IRAs be converted to Roth if you pay the tax at the time of rollover? I think, yeah, and the other thing too is people who have a taxable estate. Now, this year it's 13,610,000 per person, but let's say you have a taxable estate and you have an IRA, it really makes sense to do a Roth conversion because the money that you pay in tax is no longer in your estate. And so the weird paradox with these retirement accounts is if you do have a taxable estate, under current law, over 90% of your IRA ends up going to tax because you have to pay death tax at 40% and you have to pay California income tax at over 50% now. So when you add up the state and federal, when you add those two together, you're over 90%. So it's really important if you have a taxable estate to really take a close look at the Roth conversion.
Yep. Secure Act. So the Secure Act 2.0, I did want to make sure we cover this because we did a webinar last year. This was something where a massive piece of legislation was passed in the last 2 weeks of 2022. And it's something that continues to change. There was Secure Act, the original Secure Act that was done pre-COVID in 2019. And now we have Secure Act 2.0 that is still kind of putting into some different things in place that are weren't able to be fully implemented. There weren't mechanisms, Congress passes legislation and then you got to figure out how to actually monitor it and implement it and have ways to roll things out. So some of the things that have come into effect is the RMD age. If you're born 1960 or later, your RMD age is 75. If you're born prior to that, your RMD age is 73. So that means required minimum distribution. You're required to start taking money out of qualified accounts, whether it be IRAs, 401ks, etc. They did reduce the penalty for missed RMDs. So if you turned 73 and you were supposed to take money out and you didn't, they reduced the penalty on not taking an RMD. That also goes for inherited IRAs if you forgot to take a required distribution. One of the things that is also supposed to go into effect this year is inherited IRAs that they have said you have, if the decedent passed 2020 or later, you now have 10 years to fully empty that inherited account under most circumstances, with the exception again of special needs trust, minors, etc. So general rule of thumb, 10 years to empty this out. And there had originally been no required minimum distribution annually that had to be taken out. And then they said, well, if the decedent was of RMD age when they passed, now they have to, but they haven't required it to date because there's been no mechanism to monitor that. So this is the year where we are planning as if, even if you're under that 10-year rule and you still have 6 years left to go before you have to have this account emptied out as an inherited IRA, you're going to have a required distribution you also have to take. So that distribution might only be 4% or based on your uniform life expectancy. It's a very difficult calculation that they don't make easy for the general population to understand, but there's a specific amount. If it's 4%, it doesn't mean that just because you have 6 years left, you have to take, whatever's left in the account balance and divide it by 6. It might only be 4%, but you have to have a plan of what are you doing with this whole account balance. It's going to be taxable when it comes out within this 10-year time frame. So annual RMDs probably going into effect this year. We still haven't heard. We're planning as if.
Well, I would say,
let me take a stab at translating because there's a lot in there. If the person you're inheriting the IRA from has already begun their required minimum distributions, you're going to have to take minimum distributions for that 10-year period. If the person is not yet taken minimum distributions, you don't have to take minimum distributions for 10 years. but that doesn't mean that you shouldn't. And really, it's a
Right.
math function. And it's really, some of these IRAs, if you think about it, the rule of 72, if you inherit an IRA that's worth $1 million and you don't have to take any money out for 10 years, that's probably going to be worth $2 million at the end of 10 years. I mean, just roughly speaking. If you're a California resident, that's a couple $100,000 in California tax. If you're not a California resident, you don't pay it. So this is real. This kind of
go get an Airbnb in a tax-free state where you
exactly. This like pulls it. This is, you see where we're going with this. Like, this is something that, and I think, we were talking about this internally this week is I think that people, when they look at this too often, we're on this annual cycle as humans, right? So the 4th of July is every year. We're just thinking year. It's really important to broaden your horizon to a multi-year perspective, because it can take you a couple of years to extricate yourself from the state of California. They don't want to let you go. If they think they get some tax money out of you, there's a lot that they can do to keep you a California resident. But it's important. I think the takeaway is take a multi-year approach. And the other thing that Alyssa mentioned is employing children in your if you're a business owner, employing children, that really makes sense, because if you have employees, if you're employing your children, they're licking postage stamps, maybe you're using their likeness, whatever it is. Obviously, they have to be doing something to get that paycheck, but that's earned income. And that means they can put money into a Roth, right? A Roth IRA. And that can be really powerful. So what is the Roth contribution limit? 7,000 this year, right? It was on the prior slide.
For the IRAs. But
The
the
IRAs, yep. Roth contributions, if you have a 401k, it's 23, but
yeah, but if you got a kid on there, they can put money into a Roth IRA. And you put 7,000 away for 5 years between 18 and 25, 7 years, you're a multimillionaire, when you're 65. So when you roll that out.
So those are some of the things that are kind of already in effect, and employer matches can go towards Roths now, but it's considered taxable income. They're looking at requiring in 2026. So this isn't that still to come, that mandatory Roth catch-up contribution, meaning if you are age 50 or over and you are doing a traditional contribution pre-tax, your employer has historically matched on the pre-tax side. Now it'll be required, even if you do all of your 23,000 into pre-tax, or sorry, 30,500 for this year. If you do all of that into the pre-tax component and you're 50 or higher in age, your employer's required to put that into a Roth. That means it's going to be taxable in your W-2. So that part will come out tax-free in retirement, but you're going to get taxed as part of your income. If you're doing a traditional 401k, I'll say that again, you're going to have a little bit of additional taxation if you're maxing it out, because your employer's matching part, whether it be 4%, 5%, 6% match, is going to be required to go on the Roth if you're over 50 starting in 2026. So just something to be mindful of.
And so that's a tax increase, basically, is what it is.
Yes.
Right? It's because it's, all things being equal, a taxpayer given under the circumstances would pay more tax. This is also something to pay attention to. Over the last 4 or 5 years, worldwide, the percentage of gross domestic product in the big countries that goes to taxes has been increasing. Taxation is increasing. It's a fact. When you look at our demographics, you have all these baby boomers leaving the workforce. Taxes have to go up. And if you think taxes aren't going up, I mean, maybe you're an optimist, but this kind of plays into the concept of putting money in a Roth, because you're not going to pay tax. And, they say, well, could they change that 20 years from now? Yeah, but they probably wouldn't do it retro. I don't think they could do it retroactive. No. So, but they could stop it going forward. So
the other things that are still to come in this right-hand column, the increased catch-up, that is supposed to be coming from Secure Act 2.0. So allowing people an opportunity to put more money into retirement accounts if you're over age 60. So they're going to kind of give you an additional, if you're kind of in that playing catch up, if you will, on retirement planning, you're going to have an opportunity to put more money in, but that won't come into effect till 2025. So some of these things, again, they couldn't fully implement this massive piece of legislation all at once. The changes that are going into effect this year, penalty-free withdrawals So again, if you take money out of a retirement account before 59.5, Roth or not, there's a 10% penalty. They're going to allow a $1,000 penalty free withdrawal for emergencies. And employer payments can start going towards student loans if there's a match. So if your employer matches for 4%, if you put in 4% of your salary into the 401k and your employer matches, you can have that match go towards paying a student loan. Now, it can't just go to the person and be used for anything. It has to be directly towards a student loan. So there are mechanisms to do that. If that's something of interest with your employer, there's the ability to do that this year. Qualified charitable distributions. This is where someone takes money that is otherwise required as a minimum distribution. If you're required to have a distribution come out of a retirement account, you can have it go directly to charity without having to recognize it as income and satisfy your required distribution. You can also simply start giving from your retirement assets at 70.5. So you have to be 70.5 to do it, but you can actually start giving from those assets and not have to recognize it as income. And they indexed it for the first time. It was always capped at 100,000.
I'm glad you brought this up, because this is really interesting, because it used to be tied to the required minimum distribution. So you used to have to take money out at 70.5. Well, what happened is they bumped that age up to 73. So now you have a couple year window where you can take money out of a retirement account and well, it actually goes from the retirement account to charity, and it's distributed. Now this could be religious institutions. It could be art, Museum of Modern Art. It could be whatever sort of 501c3, not political organizations. There's some other ones in there that are not tax exempt, but these are tax exempt charitable organizations. And this is really powerful, because if you're going to some event and you're like, hey, I want to give 10,000 to the college fund or whatever, you can make that. If you're 70.5, you can make that from your retirement account if it's structured properly. And that's something that Christine and Alyssa can certainly walk you through. I don't know if you have any information. Maybe we could post in the link when this goes on to YouTube. But I think it's a really powerful strategy. Now, why would give the use case for why somebody would make a contribution from an IRA versus taking the money out and then making the contribution and taking the income tax deduction? Because when you look at that, you go, well, that sounds like the same thing. Why is it better to go directly from the IRA to the charity?
Yep, go ahead.
I was going to say, I'm going to run through this quickly because I know we still have a little bit of content. I want to make sure we get through some of the content for the slides, but it's an above the line deduction. So above the line deduction, meaning if you have $100,000 of taxable income, or if with this required distribution, let's just say you have 80,000 from Social Security, pension, all that, 80,000. You have another $20,000 that you're required to take out of your IRA. And if you take that 20,000 and then give to charity, let's just say that you take that 20,000, you now got $100,000 taxable income, you give 10,000 to charity. Well, that 10,000 is below your itemized standard deduction. You'd have to itemize in order to really get that deduction. So you don't even have to itemize. If you have, let's just say that you take that 10,000 as income, you've now got 90,000 taxable income and you still get your standard deduction, but you also gave 10,000 directly to charity without having to itemize. So you end up getting more to charity, paying less in taxes. Even if you do itemize, there's typically a calculation. We can run the scenarios where you're giving directly to charity before it coming to you, and then having your tax bracket be subject to the itemized deduction or standard deduction.
Yeah, so there's an interplay. This is on the lower end. So if you're not itemizing deductions, it makes sense to have it go from your IRA. If you have a lot of income and you take that distribution, it might push your other investment income into net investment income tax, where you're paying another 3.8%. So whether it's a big or a small number, we really need to pay attention. This is why Christine and Alyssa work with the client CPAs, is you really have to pay attention to what the taxable income is for a given year. And it might make sense to do a qualified charitable distribution in a given year. It might not make sense to do it in a given year. It really depends on the facts and the circumstances. 529, what's this Roth IRA with the 529?
That came into effect this year. There's a lot of nuances in here, so I'm not going to cover all of it. But the main thing is if you had a 529 account that's been in existence for 15 years, 15 years is the requirement, and you had a kid that didn't use all of those funds for college, you can roll over the annual IRA contribution limit. So if it's 7,000 on the Roth, you can put 7,000 of the 529 balance into a Roth IRA for that same beneficial owner, the child, adult child, whatever unused funds are in a 529 can be switched over to a Roth IRA, but there's annual limits, there's total limits. So there's all these nuances that go into it. But a lot of people have 529s that were overfunded and there's extra money there and we can convert it to a Roth. So that is in effect now.
What if you have leftover 529 money? What do you do with it? If, like, the kids all went to school and there's still money left in, and then maybe there's no grandkids. What do people do with those?
Nieces, nephews.
Yeah. You can change beneficiaries, you can pull it out.
Okay.
Generational educational legacy funds. There's all kinds of things that we can do. Secure Act 2.0 is one of the things that we were expecting to come from the Secure Act was disallowing backdoor contributions as well as mega rollovers. So like if we were to take a 401k and major Roth conversions, large Roth conversions, or having required distributions from mega IRAs, all these things never came into effect. So there's no forced RMD on a Roth. The qualified distribution age still remains at 17.5. So there's some things that didn't change that we expected to.
So if you're nearing, oh, go ahead.
So nearing retirement, every day I get closer. I guess every day we all get closer, I guess, whatever that day is, unless that day keeps moving out. And I would say this is, I think many people, regardless of how much money you have, okay, I think many people are afraid of outliving their money.
Mm-hmm.
You could have $50 million and be worried you're not going to outlive your money, right?
Mm-hmm.
So I think if you're afraid, if you're watching this and you're like, oh, that's me, I'm afraid I'm going to outlive my money. I think it's a natural fear. And I would say, let me just validate that by saying it's okay to feel that way. And there are things you can do to make yourself feel better. I mean, this is really a feel good exercise, but doing a budget, I mean, this goes right to maintaining your lifestyle through retirement. Well, let me ask you, because this actually came up. My wife the other day said, we really need to figure out how much we're going to need in retirement. So I'm 54 and I did marry an older woman. She's 55. Maybe talk about budgeting. That's kind of interesting. I don't know that how much people pay attention to that. Because I ask people, how much do you spend every year? About half the people are pretty spot on and quick in answering. The other half are like, I don't really know. Is that common? Do you see that with your clients?
I'd say the vast majority of people don't have a real pulse on exactly what they're spending. They know the average debt that comes out if they have a mortgage, they know all of those things, but whatever's left over as far as what they're living off of, their net lifestyle needs, the vast majority of people don't actually have a real pulse on it.
Yeah. So what we typically will do is we'll kind of forecast what the potential cost of long-term care would be, because you're typically if you're a married couple over the age of 65, you've got a 76% chance one of the individuals is going to need long-term care coverage. So what's the potential cost of long-term care? Do we have room for that in the estate? Do we need to self-insure? Do we need to transfer the risk of insurance? All of those things, it requires a plan, but sometimes what we'll do is we'll back into what's been your annual income. Because whatever you're used to having as an income, most of the time, unless you're banking a certain amount of that and saving a very hefty chunk, we kind of back into, okay, well, maybe you did your 401k contribution, but if you're used to making this and you do your 401k contribution and you're no longer going to be doing that in retirement and you pay this much in income taxes, you're not going to change your lifestyle. So we kind of sometimes help people back into their budget just by looking at thear tax returns and just going, unless we know you're saving this amount every year, this is what we got to work with, because you're not going to start living on less, especially your early years in retirement when you want to go, do things, travel, you have the physical means to go do more things. A lot of times we have to back into it because most people don't know. But having a plan is critical.
Yeah, it's interesting. The number I hear most common is about 250,000 for our clients. That seems to be because living in California is expensive, but a lot of people are spending about that when they and I would say if you're spending that in retirement, I would say that's kind of a normal. Now it may sound like a lot of money if you're watching this, like wow, that's a lot, but I would say even people with very large estates oftentimes aren't really spending more than about 250 a year. So we do have some questions. I do want to get to some questions. I know we do have a little bit more here, but I want to answer these. If an IRA passes through to a beneficiary, why would that be part of the gross estate? Because everything that is includable in your gross estate is included in your gross estate. IRAs are includable, so it's something that's in your name when you die. That is part of your estate. So is death benefit on life insurance. A lot of people are unaware of that. If my tax bracket is much higher than the beneficiary's bracket, isn't that an incentive to not convert to a Roth? Yeah, it's a math function. Except remember that beneficiary after 10 years is going to have to take out all the money under most circumstances. Anonymous asks, can you please share the link for 35,000 you mentioned for 2024, the employer to contribute to Roth 401k when you're 50, 55? I think if you can do that, Ashley, that would be helpful. What about charitable annuity trusts is a way to gain reliable income and avoid tax on RMDs? What about QLACs? What's the acronym for QLAC?
HELOCs, okay, so do they have a purpose? They do. Have they ever made so much sense that we've done it for a client? No.
Yeah.
I'm not going to say that they don't make sense for the right client, the right circumstances. We typically in our clientele are dealing with a higher net worth accredited investor client base. And so when you're typically dealing with a higher net worth client, those typically don't make sense.
Yeah, and I would say that the charitable trusts, we've been in a low interest rate environment for about 15 years. Interest rates popped, and that had inverted a lot of planning strategies. So we put down a lot of planning strategies and picked up a lot of planning strategies we hadn't picked up since.
And the charitable gift annuity, I'd say charitable gift annuities are very infrequently used now that there's more modern forms of charitable strategies like a donor advised fund or a charitable remainder unit trust or different types of charitable trusts. Typically, I mean, unless we're dealing in very small amounts, like I'm saying 250,000 or less, a QLAC or a charitable gift annuity, those types of things, generally, rule of thumb, tend to not make sense unless we're dealing with, a smaller sizable estates.
Anonymous asks, regarding leftover 529 funds, worst case would be funds are pulled out and the earnings portion only is subject to federal and state income tax plus federal and state penalties. Correct? Yeah, that's correct. Your basis, you're fine. I guess it depends if you've maybe made some distributions. We would have to kind of do the math on that. Anonymous asks, the first beneficiary in a retirement account is the spouse, but we are advised that the contingent beneficiary, if the spouse dies, should be an IRA trust. Has that changed? No. So when we talk about trust, we talk about living trust. So in our firm, we do a lot of IRA trust, IRA legacy trust. It's a special trust designed to receive an IRA with very special, specific provisions. That has not changed. If you did your IRA trust before the Secure Act, so if you did your IRA trust before 2020, you were going to want to have that looked at. Is a charitable remainder trust income taxed? Yes, distributions are taxable as they come out to you, as those payments come out. It's going to be part tax as income, capital gain, and part basis. So you're not going to pay tax on some of it, most likely. Anonymous asks, if I don't mention IRA or POD accounts in the trust, how does the government know it is part of the estate? At death, does each institution report it to the government? Yes and yes. So they're not necessarily reporting the asset, but there'll be a 1099. And then somebody has to sign an income tax return. Somebody has to sign a death tax return as Form 706 if the estate is large enough or it's otherwise warranted. And if you don't report everything, that's the jail time kind of thing.
I would not try to outsmart the IRS.
No, there's a CPA who was 72 years old, just sentenced to 25 years in prison for doing syndicated conservation easement, 25-year sentence. Anonymous asks, is there a new law that allows up to 50,000 per person to count towards RMDs that goes into a CRAT? Nope.
No.
Where do you find the details you mentioned for retirement contributions for 60 or older? That's proposed. Is that proposed
That's
legislation?
in 20. So some of these things, again, we kind of covered what's in effect, what's coming. So some things are in effect now in 2024. The Roth employer matching is coming. It's not into effect yet. There is no mechanism yet that's requiring that. And then in this age 60 to 63, that's also coming. So some of these things are 2025 and 2026. So we'll do another update next year when we kind of go through what is now in effect that was put into the legislation, the Secure Act 2.0.
Great.
And I'd say the IRS is no dummy. They know exactly what they're doing. The tax laws are due to sunset in 2025. So postponing some of this legislation to create more taxable income to you in 2026 is by design. So it's not a generosity thing at all.
So retirement income planning, great questions. We covered budgeting. How are you going to replace your income? How are you going to live? How does pension and Social Security play all into this? When should you take Social Security? I think that's part of that Social Security strategy. And that's something, Christina and Alyssa, I know you and your industry in general, there's software out there that does this calculation, and when you run the numbers, you say you should take Social Security in this month of this year.
Yep.
You can get down that granular. So,
Yep.
And then RMD planning is very important.
Critically important.
It's really important because there's a lot of planning you can do before you hit your required minimum distributions. Once you have your required minimum distributions, the planning gets a lot harder, frankly, is the bottom line, right? So your options are fewer. This is a real important one. Review your estate plan. I think you should review your estate plan every year. Everybody, if you have an estate plan, need to look at it at least once a year. And it's a really good idea because it refreshes you. These are the people that make decisions for me when I can't make them for myself. These are the people that get what I have when I pass away. And this is the way it's distributed. One of the big ones for us is, a lot of our clients want to reduce estate tax or death taxes. You need to pay attention to where you own property. So you might be a California resident, but own property in Oregon. Well, Oregon has its own inheritance tax that starts at $1 million. California doesn't. California is a great place to die with all your assets in California, especially if you're married, because you get an adjusted cost basis on community property. Can you use lifetime gifting? I will say a lot of our clients use that. What does that mean? Well, that means this year you can give $18,000 per person. So if you're married, $36,000 per kid, let's say, you can double up. The spouses can double up. How do you do it? Well, you can write the kids a check. A lot of our clients basically write their kids checks every year, right? Because that is a free way of transferring wealth from this generation to the next generation, and it can be a substantial amount of money. I know there was some debate as to whether it would be $50,000 per person per donor per year, but this is per donee. So I can give $18,000 to Christina. I can give $18,000 to Alyssa. Don't get excited. I'm not going to do that, Christina and Alyssa, but I could do that without any gift tax, and I'm giving $36,000. How will qualified assets transfer to beneficiaries? Those are IRAs. If I have $1 million IRA and my kids inherit that IRA, is that going to be protected from future ex-sons-in-law and future ex-daughters-in-law? Is it going to be protected? What if one of my kids passes away a couple years after I pass away? Who gets that money? If the IRAs are large enough, that's why a lot of people do this specialized IRA trust planning. So if you have a large qualified plan, and I would say if someone's going to get 500,000 or more, 300,000 or more, something like that, if one individual is going to get that, it makes sense to have a wrapper, a plan around that qualified plan, because around that qualified money, that IRA, that 401k, because that's a lot of money. And if the person inherits it, there's zero creditor protection. It's subject to divorce claims and a whole bunch of other, a litany of claims. Also another death tax. So if it's a larger estate, it's again taxable when that child passes away. And then annuities. But charitable goals, if you have charitable goals or don't have charitable goals, are those going to be fulfilled? How do they get fulfilled? On a very high level, and I do want to finish. I want to finish this slide with annuities. On a very high level, if you're going to give $1 million to charity, you're better off giving it out of your IRA than you are out of your living trust, because that when that charity receives that $1 million IRA, they're not paying income tax on that. So that's just kind of a nuance. And I had a client years ago who came in with millions of dollars going. And they had millions in IRAs and millions in non-IRAs, and the non-IRA money was going to charities and the IRAs was going to the people. And I was like, you kind of have this backwards. You should have qualified money going to the charities because they're not going to pay income tax. Annuities. A lot of people have annuities. There are a lot of people who say, I think annuities are the best thing. And a lot of people that say, I think annuities are the worst thing. I'm not passing judgment on anyone who may or may not have an annuity. It's very important to understand an annuity is a contract. What does that mean? You give money to the insurance company and money comes back to you or your heirs. The gain in an annuity is taxable as income. And it's very important to understand. And many times people want to put their IRA into a living trust. And typically these are held individually and the beneficiaries are individuals as well. So that's kind of what we see. Can you put it into a trust? Yes. But again, you're going to want to pay attention to who the beneficiary is on the annuity and who gets that. And there's some income tax planning strategies around that. If you have a significant gain in an annuity, that Christina and Alyssa can help you with. As I mentioned, the annual gift tax exclusion is at $18,000 per person, and it's $13,610,000 or a little over 27 million if you're married, meaning you can leave $13,610,000 if you die, or you can give it away, and anything above that's taxed at 40%. That gets cut in half in 2026, and we're estimating it's probably going to be 7 million in 2026, and the tax jumps to 45%. So big change if you have an estate. If you're single or married with an estate of more than $5 million, if you're single, or more than 10 million if you're married, you're going to want to pay attention to that. The clock is ticking. I love this. 13.61 million. But it's getting cut in half. And the way we talk about this is a cake. So the cupcake there is the Obama cupcake and the Trump frosting. That extra $5 million exemption tied to inflation, which gives you that 6.61 million, that is getting wiped away. That's going away. And if you make a gift, you make it out of the cupcake first and then the frosting. So to make this efficient, right? So when I'm saying, don't just say, hey, I've got a $10 million estate and I'm going to give my kids $1 million. You're making it out of that cake exemption. So you're really not helping yourself until you get up into the frosting. And I know you might be listening to this and going, what are you talking about, Jim? What I'm talking about is this is not easy. And very few lawyers understand this. I would say very few financial advisors understand this. The three of us on this webinar understand it because we deal with it every single day. So we have, what are the opportunities ahead of 2026? What can people do in the next couple of years?
There's a lot we can do. So whether it be shifting different types of trusts, whether it be a dynasty trust, we're going to throw out a lot of different types of advanced planning strategies. And we're going to probably do quite a few advanced planning webinars together over the next, 18 months, as far as what things do we need to plan for now so that we can use the frosting and the cupcake and use some of our gifting exemption while we've got that ability to use both before we get limited in what we can get out of our estate and to our heirs. Do we know we're going to be significantly above both the cake and the frosting, or we're going to have this huge estate where we have to start thinking of, okay, how do we start getting money to the next generation, or a legacy, or charities? Maybe we want to give money to charity in the future, but we want to have some benefit from it now. There's all different types of things that we can do to make sure that you and your hard-earned money and your heirs are not paying 45% to the Franchise Tax Board and the IRS. And that's probably the nuts and bolts of it, is there's things we can do today, but if we wait until the 11th hour in 2025, we're not going to have as many options.
Yeah. And on the estate side, I got to tell you, most estates, if you have a $10 or $20 million estate, there's a lot of stuff in there. It can take 8 months, a year and a half to fully implement these plans. And, if you wait until 2025, there may not be enough time. If you wait until, the summer of 2025, good luck finding a lawyer, because we're all going to be busy, and we're going to be busy into 2026 dealing with all the stuff that happened in 2025.
And some of this is simply just creating the structure.
Yeah.
And
right.
we might just simply have this trust sitting over here waiting to be funded because Congress, we get through the election, nothing's going to happen in 2024 because it's an election year. Then you have all the new Congress and the new swearing in, and then it takes them, time to actually do all their negotiating and dealing, and maybe get their jobs done, or maybe agree and pass legislation. And so if we're sitting here at the 11th hour and we don't know what Congress is going to do, yes, the sunset goes fully into effect, we at least have this vehicle where we can go, trust is created, we can go put all the money that we need to put in there, and we've got the vehicle. So sometimes this is just simply creating these different levers to pull that we'll have available to us to just say, hey, this trust exists. We might leave it unfunded because we don't know what Congress is going to do. We might choose to fund it in December 1st of 2025. We might just say, yep, we know we're going to have to fund it. We're going to put all of this money into this bucket, and we've got the levers to pull. So some of this is just creating the strategic plan, creating the design, making sure it's well thought out, because once you do it, a lot of times these things are irrevocable. So we want to make sure that we've got a well thought out plan if we have to use it.
And the way you do that is working with a team of advisors. So it necessarily involves a lawyer, financial advisor, and CPA or other tax advisors. So very important, that three-legged stool.
Yep.
Christina or Alyssa, explain what happens in the initial consult. So what I'll do is I'll go back here and maybe to this one, and maybe walk us through what happens in an initial consult with Ascent Wealth Management. What's the process?
Sure. So when we receive any client that wants to meet with us, that's a client of Cunningham or is coming from one of these webinars, what we'll do is we'll meet with them complimentary for the initial consult. We'll gather a bunch of information, and really what we're trying to get to is how can we best assist you? How can we make sure that we're getting to your needs and your goals and accomplishing all of those, as well as addressing any concerns that you might have and identifying any red flags or glaring issues that you might have. And so we're really trying to get to, in that initial time, maximizing our time. So getting as much information from you as possible, and getting that ahead of time is really advantageous so that we are maximizing that complimentary time with you, and then making sure that we're then making the appropriate referrals either back to Cunningham for addressing various needs that you might not have thought of, as well as getting to addressing those goals and issues that you might have.
Yeah, we really want to make sure that we are identifying if we can help you and if we're a good fit. We want to make sure, we are a large firm, but at the same time, we want to remain boutique and not get so cookie cutter like a wirehouse. And I say wirehouse like a big, insurance company or a big bank firm, an Edward Jones, a Wells Fargo, some of the big names, Fidelity. We want to make sure we can still be boutique, meaning customized in our clients' needs. And if we want to identify if we're a good fit and how we can add value to your situation. Our value is in financial planning, and that we all have accredited estate planning designations. We want to make sure that your plan is well integrated with your estate and tax planning.
So subscribe to our YouTube channel, and you click the little alert button, and it'll pop up an alert when we post our new content, which is typically 6 p.m. Pacific time. And also give us a little thumbs up and like our videos. That helps. It warms my heart every time we get a like on our video. We have offices in Northern California and Southern California, in the Capital Region, Bay Area, and LA area. And these are our phone numbers. We have a lot of phone numbers. I don't even know that people pay attention to area codes anymore. It used to be, this is before your day. When you dialed a 1 before you dialed something else, you were going to pay money, and your mom was like looking at the clock, like, you got to get off the phone.
Yep.
Those are our phone numbers. Feel free to reach out to us. Next week, we have another webinar, which is on February 1st, so week after next, selling a business, maximizing price and reducing taxes. If you're a business owner and you're going to sell your business, you're going to want to watch this, because there are things you can do 3, 4, 5, 6, 7, 8 years in advance to increase the value of your business, as well as increase your after-tax benefits. So we've got Matt Garrett from TGG Accounting. He will be joining us, and he is a consultant to businesses to help them increase their value. Subscribe to our YouTube channel, and we will open it up for questions. If you're watching this on YouTube, just keep watching, because another video is going to magically roll up after this one.